So we've talked about the BRRRR strategy, and that's buy, rehab. So we know that hard money loans are covering the buy and the rehab portion. Now, once our clients are working the BRRRR strategy, they need to get the property rented. They need to get it under contract for lease. So that may be them, it may be a property management company. But at any rate, they need to get the property rented so that it can show some value alternative to their personal income. They close on the property in their business name using the hard money loan. So it's already in their LLC. There's only a few loan types that will close when the property is in a business name. There are conventional loans, there's traditional financing, commercial banking, those types of lenders exist. We are an alternative to that because all of those other loans require some sort of personal asset or personal income verification. You got to require your tax returns to be done. The DSCR loans, it's a debt service coverage ratio loan. So breaking that down, it's measured based off of the property's ability to pay its own debts. Those debts being principal, interest, taxes, insurance, if they're in an HOA neighborhood, or if there's any other fixed expenses by way of flood insurance or something specific to that neighborhood, those are accounted for. This is specifically for the single family 1 to 4 space. DSCR is across the commercial lending industry and it's used for other types. But when I'm talking about DSCR specifically for the BRRRR strategy, we're talking single family 1 to 4s. All right. The purpose here is to pay off the hard money loan that you got up front and put it on permanent financing. When we're talking to our clients about a DSCR loan, they're going to want to talk about interest rates. But here's the thing. I want you guys to adopt this philosophy when it comes to the DSCR loan interest rates because they are higher than their conventional counterparts and their traditional lending counterparts, those ones that I just described that require you to have a longer process and more proof of income to qualify. Yeah, these have a higher rate, but this is based off of cash flow. So if it cash flows, it cash flows. The goal of the BRRRR strategy is not to live off of this income. The goal of the BRRRR strategy is to build and scale a rental portfolio that will eventually be able to appreciate over time, and the cash flow is a bonus. The BRRRR strategy allows you to move with velocity because you're finding distressed properties, you're fixing them up so much so that when you go to refinance, you're pulling out your initial investment, that down payment that you had, that 10% towards the purchase price that you had up front for the hard money loan. If all you need is that 10% plus points, fees, and closing costs, you just need to find that and you can start your next deal. If you're able to access that because you improved the property so much that when you go to refinance, you're pulling that out, that's the repeat. That's the repeat. By the way, the way that you have to phrase this to your clients is that it's tax-free income because it's a loan. It's a loan from the property to you so that you can go and buy more properties. The average cash flow per door in the single family 1 to 4 space right now is anywhere between $200 to $400. To replace someone's income, they'd have to have a lot of doors. So and that is the direct effect of the interest rate. But when we're talking about a DSCR loan, as long as it cash flows, it's going to be approved. That cash flow number is 1.0. If you guys understand what a ratio is, a 1.0, that ain't great. That's breaking even. You do want to see them at a 1.1 or 1.2 or higher. That means that they would be getting 10% or 20% more return each year. But if it cash flows and they're able to get their initial investment back, that's how they're able to go and move forward and go get the next property. That's the repeat portion. Okay. So here's the breakdown of the DSCR loan process. It's different than the hard money loan process because we're starting we should have already had all their paperwork. That we're not starting from scratch here. We took their paperwork when we did the hard money loan up front, and a lot of the lenders that I work with in our lender network, we're doing the hard money and the DSCR loan with the same lender so that we can streamline the process. We can be within that 90 days, or we bounce to whoever has the best pricing at the time. That's the benefit of being a broker. All right, so the refinance, the property's rent ready. They got a tenant in there, or a tenant's about to be in there. This could be in month 2 or month 3, month 6. We get them a pre-approval letter. This is based off of their credit and the cash that they have available. We're going to order another appraisal to confirm that ARV that we got before, or maybe it's worth more because, this could have taken a little bit of time and some other properties could have sold in the area that were similar and push the value up just by that. Then it's good after the appraisal's done. This is where the differences between the hard money loan and the DSCR loan. Dating versus married, does this have a big effect on them getting approved with underwriting? What that means, Michelle, when I'm saying dating versus married, is the underwriter for a hard money loan is looking at this like, okay, they got to have a clear exit strategy. If they're only in this for a few months, then they can sell or they can refinance. Married, like this is a 30-year loan. So it's a little bit more of a process when they're underwriting the deal. They're going to take consideration of the comps. They're going to do their due diligence with what the property is renting for in the area because this is permanent financing. They're getting married to the property. The lender is. The the borrower's not getting married to the lender. The lender's getting married to the property, right? Once the underwriting is done, then we go and confirm terms. We grab insurance in the title documents, same process as before, get that clear to close, and then we get paid another 1 to 3 points, another 1 to 3% of the loan amount, depending on the size. If you could just help a single client do this process and earn 1% on the front and 1% on the back on a $200,000 loan up front and a $500,000 loan on the back, that's $7,000 that you just captured. Could that go towards marketing? Could that go towards finding another property? Could that fund your lifestyle? Could that help you see a different vision for your business where you are helping your clients build and scale their rental portfolios by getting them access to what they were already needing in the first place?